It's November 8, 2008. This is Maximize Utility. Today I want to start a series of short pieces on investing techniques. And I say investing techniques that don't work because I think the markets are pretty much efficient. And if you're going to try to beat the market, you're going to take more risk. And the technique I want to talk about today is a way of getting a guaranteed rate of return and then making a bet on something. I bring up this particular technique right now because it's been in the news. I see this article in the Wall Street Journal about a guy, Nassim Nicholas Taleb. He's a well-known market guru, and his basic story is that markets will have tendencies to crash more often than we think. They call them black swans. And he's been investing based on this idea. And I'll explain to you what he's been doing, and then I'll try to show you what I think the flaw about it is. So, here's the basic strategy. Take $1 million and take $950,000 of that and put it in some kind of U.S. government bond that gets you about 5%, such that at the end of the year, you'll have your $1 million back, approximately. Then take what's left over, which would be about $50,000, and make some kind of bet. Now, you could go to Las Vegas and bet it on black, but what Taleb says to do is buy out-of-the-money put options on market indexes like the S&P. Now, he contends that in most years the S&P won't go down, but there will be years when it will go down dramatically, and those options will be worth a real lot. So in Taleb's strategy, you won't make any money year 1, year 2, year 3 perhaps, but then one year you'll make a real lot of money. And that's what happened this year, and that's why his strategy got written up in the Wall Street Journal. But there's another guy out there, his name is Zvi Bodhi. He's a professor of economics and finance at Boston University. And guess what? He says do the same exact thing. Take $1 million, put 95% of it or whatever in something that will give you a risk-free rate of return that will about restore your capital, and then put the rest of the money in a call option on the market, because he thinks that the market's going to go up over time. Now, you can see how the technique itself is very, very simple. The only question is, what kind of conviction do you have about where the stock market's going to go? That's a tougher question. Let me show you an example of somebody who made a bet. This is a page from my October 31 brokerage statement from my Simple IRA account. And if you can read it, you see I'm holding an option. It's a call option. It's called a LEAP. That's a long-term option. It comes due in 2010. It's on the S&P 500 index to be at about 1,800. Now, that was out of the money when I got it about a year ago, and it's even more out of the money now. I got 2 contracts. The total cost was about $10,200, and today it's worth about $2,000, so I lost a lot of money. Now, that was a variety of a Bodhi strategy. I say a variety because in the rest of this account I didn't have treasuries, but I had other stocks and things like that. Anyway, it didn't work out. It's not that I didn't know about Taleb's strategy at the time. I surely did. He's pretty well known, and the idea that markets can crash is pretty well known in general. But the question for you is, what conviction do you have about where the market is going? Perhaps today you should convert from a Taleb strategy to a Bodhi strategy, figuring the market's already gone down, it's going to tend up. But that might be priced in, so you might find that the prices of calls are high. So the question is, what do you think will happen to the market? And that's tantamount to saying, what do you think will happen to the economy? And we know that's a really tough question. Now, you can't rely on the people here. Nassim Taleb and Zvi Bodhi are about equally well thought of in the business. And if you read the article, Nassim Taleb's strategy had used it for a number of years, and he had to abandon it because it wasn't successful.